Right. So we would look at 5.2 today. My internet is unstable. Am I audible clearly? Yeah, okay. So we will look at 5.2 today. So we looked at 5.1 in the last class where we learned the jurisdictional blending as it is called. Now we will look at SBIE. This would give you more clarity onto how globe taxes are computed. Okay. So after completing this chapter, you will be able to calculate the SBIE, which is substance based income exclusion, using the payroll and tangible asset carve outs. Apply the correct transition rates for each fiscal year and determine the excess profit subject to top-up tax. Now, you tell me one thing. You already know what is substance-based income exclusion. We learned it in chapter 2, right? Why would you need to have a substance-based income exclusion? So, where are we in terms of computation? So, I'll just open my sheet. Yeah. So what is happening is, let's say that you found ETR. Okay, you found globe income, and sorry, you found cover taxes. You divide it by globe income, and you find your ETR. Correct. This is where we are. And let's say that I am saying my ETR is 10%. Okay. Now what do I do? What do I do to understand what do I do next? Okay. So first I will find the top up taxes. Top up taxes is nothing but 15% minus your jurisdictional ETR. Okay. So I'll call it JETR, jurisdictional ETR, and that would be what? That would be 5% in this example. Correct. Now what are you multiplying this 5% with? How will you find the top up tax? This is top up tax percentage. How do you find the top up tax? Yeah. So you will take the globe income, which is the profit figure, which is a denominator, into 5%, and you will get what is your top up taxes. Correct. Now, let me ask you something. Uh, where does SBIE come in for this? Okay. So SBIE comes in like this, like, if you have substance based income exclusion, then it would be globe income minus whatever is your substance based income exclusion. And this figure is called excess profits. Okay. Whatever is your excess profit into that top up tax percentage. In this example, it is 5%. It will be your top up taxes. It will not be on globe income, even though we have all discussed till now that it's going to be globe income. But you have to understand that in reality, it is computed on excess profits. Okay. Now, what is this SBIE? What is this SBIE? We know that it is a thing about there is kind of like, if you have payroll, hmm? If you have tangible assets, then this is something related to this. We know that, right? We already discussed this before. Now, but you tell me one thing. Why am I given an SBI? What is the rationale? What is the funda of me giving a SBIE exclusion or SBI exclusion, and I'm only taxed on my excess profit, not on my global income? What would be the reason? Why would this SBIE be given in the first place? If you say it is because I am including substance and all, then I have a counter argument for you. See, this globe income is what? Your net profit. Correct. I mean, on a very least note, it is net profit. So whatever payroll you have invested, you will get a deduction. The net deducted amount is this globe income. If you have good tangible assets, then that means that our post depreciation amount is this. Then why do you have to give an SBIE extra? Hmm? Okay. They are taxing it based on how much substance the company has, so it is fair for everyone. Point noted. Point noted. That's the rationale. That's well articulated there, Sahil. But the thing is, this globe income would already have this, right? Hmm? This would be if it is a fraction of payroll and tangible assets, it's already something that is already embedded there. Then why would I need to give a separate SBI? Are you getting the point or the argument I'm raising? Yeah. So let's understand. So let that curiosity build in, and let's understand, and let's kind of like see the words and how you have to write the exam as well. Okay. So substance-based income exclusion represents one of Pillar Two's most significant concessions to business reality. Okay. The framework's architects recognize that not all income in a low tax jurisdiction represents tax advantaged excess profits. A manufacture, so it's not that every profit is an excess profit. Okay, why you have to understand why there was a need for a pillar two. It is to tax these excess profits, right? Or I could simply do profit shifting. Instead of that, so to tax these excess profits. So a manufacturing plant employing hundreds of workers, a distribution center holding substantial inventory, or a research facility with expensive equipment, these operations generate returns attributable to genuine economic activity. Subjecting such normal returns to minimum taxation would unfairly penalize groups that have located real substance in countries with competitive rates. The SBIE addresses this by carving out a fixed percentage of payroll cost and tangible assets from the top of tax base. The result, excess profit, income beyond what normal returns on employees and physical asset would justify, is subjected to top tax. Okay, so what they are saying is, yes, see, our main agenda was to target these low tax constituent entities which does not have any substance. That's why we had an economic substance regulations before to understand who are these kind of characters. So what they're trying to say is, if you what so basically why, let's come back to this discussion, why you would need an SBI is because, listen to me very carefully. This is the rationale. Okay. So what they are saying is, if you employ X amount of employees and Y amount of assets, then definitely you are doing a business activity. And in a business activity, you will get some normal gains. Okay. If let's say that, if you employ something, you will get a normal gains. This normal gains, we don't want to tax. We do not want to tax. Because if you have so much of employees and if you're generating work and all, that means it's a normal business activity. You will get normal gains. You will not kind of invest all this without a business opportunity in mind. So those normal gains, we don't want taxes. We want to tax only the excess profits. Okay, so let's say that if I'm doing a drop shipment, this is one business model that we have seen very prevalently in our practice. So what happens is, there is no employee, no nothing, right? But still they are generating profits. That, my friends, is excess profits. Okay, but what you have to understand is, if you are employing people and you are doing a legitimate business activity, you should get normal gains. The whole framework is not anti-capitalistic that you have to tax everything. No, you should enjoy normal gains. If somebody is taking a risk, employing assets and employing people and investing in assets, then they should get a normal gain. We should not tax that. That's not in the interest of capitalism. But we should be only be taxing, this top up tax should only be on excess. Did you understand loosely what I'm trying to say? The rationale. So I understand that even though this globe income is after all these deduction and all, still it's a normal gain. Normal gain, like I'm okay. see, normal gain is the reason, the justification of such a legislation is not to tax normal gains, because you are already subjecting it to domestic taxes, right? This is only for top up taxes. Sorry, this is only for excess profits which are over and above, excess profits that is earned, which is not taxed in the local jurisdiction at a rate above 15%. So that's what we are targeting, and hence they are giving an SBIE, or a substance-based income exclusion. Can you give me a thumbs up if you understood, like, the rationale why there is an additional SBIE? Because whatever you get here is normal gains. We don't want normal gains. We don't only want to tax excess profits. That is why we are giving a substance-based income exclusion deduction. Can you give me a thumbs up? No thumbs ups. Am I audible and visible? Like, then okay. So it's not no longer virtual, but it's kind of physical. Okay, I get that. So this is why there is an SBI. This fundamental reason is what is very important today. Now we will go into the metrics and how to calculate this. Okay. So what does SBIE does? Substance based income exclusion reduces the amount of income subject to top up tax by recognizing that genuine economic substance represents real business activity deserving a fixed return. They deserve something here. We should not tax it. Okay. If somebody is taking all this risk in employing people, he should be rewarded. Otherwise, the whole economy will go down, right? It's basic economics. If people are not rewarded, everything they earn is being taxed, then there is no reason for anybody to take that risk. So normal returns we should not. Only excess returns or excess profits should be subjected to this taxation. So the concept is net globe income minus SBIE is what we call as excess profit. Okay, where SBIE is equivalent tax base, and excess profit is subjected to tax. So this excess profit, yeah, excess profit is net, basically the same. Okay. I don't know why I did two times, but you get the gist. Excess profit is net globe income minus SBI, and top up tax is excess profit into top up tax percentage. Okay. You will not take the net globe income. You will always take the excess profits. Okay. And why we are doing that is what you have to really understand, because that's what you have to articulate in the exam. Not this formula is pretty basic second standard, but why they are doing an SBIE is what is very important. So SBI reduces the tax base on which top up tax is calculated, not the rate. So higher substance is equal to lower top up tax. Okay. Fantastic. So what are the components of SBIE? I know there are, 5.3.2 defines the SBIE amount as sum of two carve-outs for each constituent entity in the jurisdiction. So what are the two carve-outs, or what are the two components which are added together? That is payroll carve-out and tangible asset carve-out. The total of both of them is what is SBIE. Now what is payroll carve-out? Eligible payroll cost. We learn what some payroll cost into a fixed percentage. Now, where would we get this fixed percentage? It's already defined by, there is a whole circular about it. And tangible assets are eligible tangible assets into a particular rate which is given in the table. So this is the table, guys. So if you see, the SBIE percentages are higher initially. So for all the eligible payroll cost, you get a 10% exclusion on top of your profits, and for tangible assets you get 8%. Okay, this you see will come down, 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 and by 2023 and forward it would be a uniform 5% each. Okay, so this they cannot change. So the SPI percentage is higher in the earlier years and reduce over a 10-year transition period to the permanent rates of 5%. So it's going to be 5% from 2033. So you take eligible payroll cost into 10% if you are in 2023, into 9.8% if you are in 24, 9.6%. That is one part. That is the payroll carve out, and tangible asset eligible asset balance into whatever is the percentage. That's how you calculate SBI. Clear? Okay, so let's look at eligible payroll costs. What are the eligible payroll costs? What cost would kind of like qualify to be eligible payroll cost? So that would be salary and wages. Okay, base salary, hourly wage, it doesn't matter. Salary and wages are included. Bonuses and allowances, performance bonuses, housing allowance, yes, it is. Stock based compensation, yes. Employee benefits, yes. Payroll taxes meaning like, in India, there is an employer contribution to Provident Fund. So those things are also included. So basically, what it means is in India, you have to pay to a fund. Okay, just like a retirement fund which government is creating, where 12% of the salary is what is a contribution, okay, which will happen every month, and out of which 6% shall be contributed by the employer and 6% shall be deducted from the salary of the employee before it is given to him. So this is how, so all the employer contribution which is a part of your CTC is also included. Retirement benefits like employer pension fund contributions are also included. So if they have a private fund and not a government fund, then also it is included. So these are the eligible payroll costs. Okay, so basically everything. Now, one important question which is I tried to find out the answer, but I unfortunately couldn't. Is you see that bonuses and allowances and all the things are kind of like included. You see, one important question we could ask from a UAE point of view is sometimes the owners are also employees, right? We have a whole connected person adjustment. So, in such a case, what would be the amount that I can take for SBIE? Is it the amount that is benchmarked and put in the P&L, or is it the amount that is what is paid to him? See, you have to understand that that is not clearly put in the law because of two reasons. Number one, UAE is why UAE only has a connected person thing is because normally in other countries, the individual taxes are way higher than the way higher than the business taxes. So individuals pay a high. So if they're getting a huge bonus and allowances, he will pay that at 25-30%, while for business, he'll only pay 15%. So that's what happens. So this is not a related party item elsewhere. But UAE has a specific, UAE specifically has a problem because individuals are not taxed. So this 9% rate, in this scenario, in case of managerial remuneration, for UAE purpose, let's take a call or let's take a position that we will only be taking the benchmark fees, not the actual amount. This is nowhere written in the act, but I'm just kind of communicating the position we should take as a firm. Okay. So there is this unique challenge which will happen in globe computations while you are doing for UAE. Is this clear what qualifies? So let's understand what does not qualify. Okay. So what does not qualify? Payroll capitalized into eligible tangible assets. Okay. So can you give me an example where payroll cost is capitalized? Come on. All these IFRS knowledge, let's put into line here. When is a payroll cost capitalized? When is payroll cost capitalized? One example is right there in red in front of you. Sometimes inventory cost would include, because if you go back to costing, F5, P5, and in for CA, you guys might be doing like costing. You would understand that the total cost is made up of, or the direct cost is made up of what? Direct labor, direct material. You remember all that? Direct labor and direct material, and attributable overheads. Nobody has learned costing. So my point is sometimes inventory would have a labor part also, which is included in the inventory cost, especially when you are manufacturing. Directly attributable recognition of tangible asset, yes, very good. So that's also like very correct. So let's say I have a PPE, and for installation or something, the labor cost is directly attributed to it. Absolutely, you have to. IA 16 says fantastic there, Sahil. Another reason is research and development. There are two things called research and development while capitalizing intangible assets. Development ones go capitalized and the research ones go. So there might be salaries also. No, all these research scientists and all taking salaries, their payroll might be capitalized. So what you have to understand is all capitalized payroll is excluded. Okay, that would not be taken into SBIE except payroll capitalized into inventory. Okay, so if there is in your inventory, if there is any payroll, then that you can still take for SPIE calculations because it's directly relating to your product. But anything else like research and development and salary, 1 month salary, like capitalized because it's directly attributable to asset, those things will not. Contractor payments. So sometimes it's a very common thing in UAE where governments hire you, but they hire you from a contractor or like big companies also where you are employed with an employee recruitment consultant. Your visa would be provided by them, but you work for another company who's a client of this recruitment consultant. So these are contractor payments. Okay, so your salary will be given to you by the recruitment consultant, but the company will pay to the recruitment. You know about these practices, yes or no? So if it is a corporate payment, you're paying end of the day, the nature is salary, but if it is made as a corporate payment, it's paid to a recruitment agency and all, then that is excluded. Okay. Independent contractor payment. So let's say it's not a corporate contractor, okay, who has a lot of employees, rather it is an independent contractor. So tomorrow, let's say Ashik comes and says, sir, I don't want to work as an employee. I've taken a freelancer visa and I want to work as a, freelance independent contractor who's handling your thing. So I will be issuing invoices to you. You pay me the amount, whatever is my salary, instead of you capping it at salary. Now, if you can do that, you can do that. But those are also, uh, you know, so for those things, that is also excluded. It's not included. It's excluded. Okay. So what is included is if into the ordinary operating activities under the M&E direction and control, then yes. International shipping payroll excluded definitely because that income is not included in the globe income. It's an exemption. Yes or no? International shipping. Then a payroll for excluded entities are also excluded because these are not included in the globe income calculation. So why should I give that? Why should I put that for SBIE when the formula is net globe income minus SBIE is excess profit? That's not included there. And then why should I kind of do it there? Are you clear? What is what not? And so what are the eligible items? Normally every payroll item. Okay, every payroll item meaning bonus, salary and wages, bonus and allowances, perquisites of any nature, retirement benefits or employer tax contributions or employer PF contributions. All those are included. Employee stock options, which is happening in P&L or the vested interest year one ratio, what is there in P&L. Those and all are all included, but what is not excluded is capitalized ones, capitalized payroll costs, contractor payments, or excluded income payroll relating to excluded income. So these are what you have to understand. Okay. Now, what is eligible tangible assets for the other carve out? So what do you do? What do you do? You take all these costs and you multiply it by whatever is the SPIA rate. You will get what is the tangible payroll cost payroll carve out. And for this eligible tangible assets, what would be the eligible tangible assets? So eligible tangible assets are PPE, buildings, machinery, vehicles, natural resources, leased assets. So ROU are also included. Okay, even if it's ROU that is accounted under IFRS 15, that's also an eligible tangible asset. And licensed assets also, government licenses which you have. These are all eligible assets. So total of this of every entity. Okay, you have to take it jurisdiction wide into whatever is the rate. What is not included? Intangible assets. Okay, IP, goodwill, software, these things are not because there's a lot of valuation in terms of that. Financial assets, investments, receivable balance. cash and cash equivalents, inventory, assets under construction, capital work in progress. These things are not included. So basically speaking, it is your non-current assets which are tangible. Okay. Financial assets, maybe non-current assets, we will not be including that. These are all basically like these two are current assets. And so you have to understand non-current assets which are tangible as a common bracket which you can use for your understanding. Okay. So how do you calculate the carrying value? Basically, like, okay, payroll cost is very clear. Whatever is the cost associated in P&L into that rate. But here you have to take the balance, right? Now, which balance will you take? The fair value or the cost or whatever it is. So you have to take cost minus accumulated depreciation minus impairment. You cannot take fair value. Okay. You have to take cost minus accumulated depreciation minus impairment. Okay. Right. This is the formula that's given. So let me tell you one thing. Let to avoid the confusion, since I use the word fair value. When you have a fair value adjustment, would you go and alter the cost in IFRS or IA 16? Would you alter the cost? I think yes. I think it is yes. You just check it out. Okay, I think if there is a revaluation surplus, then we would be changing the cost itself. It's not the historical cost at which we purchase, but rather we will change this. And, then the depreciation would be like, whatever is the excess one, whatever is accumulated would stay like that. But the succeeding depreciation would be more so that, this would be at par at the end of useful life. This is what I feel, but check it out. But so it does not matter if you're doing cost or fair value method. But I think in accounting, the cost would also be changed. Just check it out. Okay, I remember from our lectures on IFRS that cost should be, but that the for general formula for eligible tangible assets is carrying value is equal to cost minus accumulated depreciation and impairment. Okay. Now there is something called location rules, which is given very in July 2020. This is not a part of your the normal law, but rather it is in an administrative guidance. Now, what they say is that if an employee or a tangible asset is located in a jurisdiction for 50% or less of the time, only the proportionate share of the carve-out applies. What it means is, let's say if there is mobile employees, let's take a very simple example of Pankaj. Pankaj is 100% not in the location. Okay, so more than 50% of his time, 50% or less of his time, he is in another jurisdiction. So he would only be given proportionately for what he's doing. So here in the proportionate basis means zero. Okay. So the person should be here in the location, then only you will get all these outsourced resource, another location employees. No, you have to, first thing you have to see is if it is located in the jurisdiction, if in the whole year, if it is 50% or less of the time, let's say that out of 12 months, 2 months he was working from India, that's fine because it is less than 50%. But given the moment that he works from India for more than 6 months, then more than 50% of the time he is in another location. So you can only get it proportionately. Are you getting the concept? Same with mobile assets also. Says shipping containers are allocated based on the percentage of the year located in each jurisdiction. So you should be in the jurisdiction. Then only you will get it. It doesn't matter if you're Sharjah or Umm Al Quwain or Alain. Jurisdiction means you. Okay. Are you getting the location rules? It's a recent administrative guidance which is given. Yeah. So this is SBI. So SBI cannot create a loss. Okay. So this is one critical rule. SBI, let's say that what is the formula? It is net globe income minus SBI is equal to excess profit. Now let's say if the SBI is more than the net globe income, it could happen. Say I have a lot of investment. Let's take Groyer and Mail, our favorite client of Melvin. It has a lot of investment on plant and machinery, assets, and employees, but it has not started generating profits. So there could be a situation where the net globe income is lesser than the SBI. Okay. So in such a scenario, it would be limited to zero. Okay, so SBI cannot reduce excess profit below zero. So excess profit is maximum of zero or net globe income minus SBI. That's a formula. Okay, right. Now, if SBI exceeds net globe income, the excess is lost. Okay, you cannot carry forward or anything. That's only an annual thing. So let's say that if you have more SBI this year, which you could not utilize, you cannot carry forward and all. It gets lost like that, just like withholding tax credit. Okay. Right. So let's say that if jurisdiction has multiple entities, then you have to calculate SBIE for each entity and agree. Same logic. So what they're trying to say is in UAE you have five entities. So you have to calculate for each entity and agree. So so you have to see. Let's say that this company has. This is Ireland. Okay, so there are two companies in there. So you have to take the eligible payroll cost, you have to take the eligible net assets, and you have to total it. Okay, and SBI calculation is this total into whatever is the rate. Say since it's financial year 25, I am taking the 25 equivalent rate in that from the table, and whatever is the carve out, the total SBI. So first you have to total it and then come. You get it? So let's say if there are multiple entities in the jurisdiction, you add the payroll costs and tangible assets and do a percentage. Okay. Even if you kind of take 4.2 into 9.6 percentage and 1.8 into 9.6 percentage and add also, it's going to be the same answer since this base rate is not changing. Okay. Fantastic. Now you can also elect to be, if you don't want to take SBI, there is an election, which I would say is the most useless provision in whole of Pillar Two. There is an election in Article 5.3.1. So let's say that you don't need SBI. You want to tax the whole net globe income. You can go forward and do it. Okay, nobody is stopping you. So you can apply for this election. So MNE may elect not to apply for SBI for a jurisdiction. So why would anybody do that? Is because SBIE exceeds global income, net globe income. So if SBIE exceeds net globe income, then election is irrelevant. There is no top up tax anyway, or there are minimal payroll on assets. So there are no much payroll on assets. So calculation of all that consultants fees is going to be more. So I don't want SBIE, man. I don't have any payroll or assets anyways. And QDMTT applies and covers liability. So if QDMTT is already applicable, then I don't need to do this for the IAR calculations. Okay. So this is SBIE. So in nutshell, what did we learn today? What all things did we learn today? So first thing we understood what is the concept of excess profits. Yes, the concept of excess profits, and we learned the formula that SBIE, sorry, excess profit is net globe income minus SBIE, and it's only the excess profits would will be taxed. Why excess profit is important? Because top up tax percentage is only on the excess profits, not on the total globe income. So excess profit is minus SBIE. Now what is SBIE? SBIE is payroll carve out plus tangible asset carve out. Then what is payroll carve out? Payroll carve out is nothing but eligible payroll cost into SBIE rate, or like payroll rate. You know where to get that. Yes. And what is eligible payroll cost? Basically everything. Okay. Salary plus bonus plus allowances, house rent allowance. All those things which you don't get here. I'm sorry, I'm on record, but still. Salary, bonus, allowances, and yeah, even stock based compensations, just writing SPC, plus payroll taxes, which is paid by employer. Okay, all these things are like, included. Okay, one second, let me get this neat. Yeah. Okay, now what is not included? Not included ones are capitalized payroll cost, except inventory, plus then capitalized payroll cost except inventory, then I think it is, yeah, then excluded payroll costs relating to excluded income, then yeah, contractual payments, contract, absolutely. Now what is eligible tangible assets? Non-current tangible assets, basically. Okay, so all the other, like intangible assets, intangible assets, receivables, cash and cash equivalents, and the likewise, like intangible assets, receivables, cash and cash equivalents. All these are financial assets. All these are not there. ROU is a eligible tangible asset. Okay, these are not included. Then what did we learn? So you understand what is eligible payroll cost and eligible tangible assets. Then we learned if it is a multi-jurisdiction, what to do. You have to kind of total it and find SBIE per jurisdiction, not on the basis of, okay. You either find out SBIE for each entity and add it up, or you accumulate the eligible tangible assets and payroll and then multiply it by the SBIE percentage. Anything is fine. You'll get the same answer. And there is something called the SBIE election also, that you can choose not to elect SBIE. Okay, so these are the fine points which we kind of like learn today. Anything else anybody wants to add? Let me see if I missed any points. Multi-entity jurisdiction. SBI cannot create a loss also. That's also there. What I missed something. So SBIE, or like, SBIE cannot create loss. Okay. So basically what it means is excess profit is maximum of zero or globe income minus SBI. All these fine points clear. This is the kind of notes you should don't write pages and pages and pages. Just write these, because these will help you in, tomorrow if you go these small notes, no, this will help you in memorizing, and this is something that we can carry and use it as small notes. Yeah, location rules. Thank you so much. See, we are missing a lot of things. So there is location rules also. This is not there in the. This is basically an administrative guidance in 2023. If you quote it, you'll get very good brownie points. And what it says is location is important. If it is 50%, of the time, the location is not the jurisdiction, then you will get only proportional benefit. Meaning, for example, let's say that Jasno is not here. He's going to be away for 7 months. So his salary, but he's working from there. So we are paying him 12 months salary. But his salary of 5 months will only be taken for calculating SPI. Okay. So that's how the proportional benefit work. Okay. So let me see if, so now you can just go through the this and find out. This is what this PPT is for. Yep, I think we are through. Okay, guys. So this is all about SBIE, why it is there and how it is, how the mechanics and calculation is done. Any doubts? Yeah. So we'll see you tomorrow.